All right. Thanks everyone for being here. Welcome to another free webinar brought to you by optionslam.com. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors, nor are we registered investment advisors. Therefore, we do not provide investment or financial advice, nor do we make investment recommendations. The webinars provided by optionslam.com are for educational purposes only. Hold on a quick minute. Sorry, folks, I had a door-to-door salesman here. Sorry about that. I am back with you. All right, so back on track. Sorry for the interruption. All right, so I am Marco, and this is my email address, optionslam.com@gmail.com. Please feel free to shoot me a message with your questions, your comments, even your suggestions. In fact, if you have suggestions for future webinar ideas, I would be very well open to any of your ideas. So please shoot me an email, optionslam.com@gmail.com. Okay, so today we are talking about something we've never really spoken about at any great length in the past. We're going to talk about the phenomenon or the trading strategy, if you will, of taking advantage of a short squeeze. So first of all, let's talk about what is short selling, so that we have a basic understanding of the concept here. So short selling is an investment strategy that speculates on the decline of a stock. A position is opened by borrowing shares of a stock that the investor believes will decrease in value. Okay, so this is done through the brokerage, through your brokerage house. What they do is they will secure and borrow stocks from some other investor who holds those shares long in their account without ever consulting anyone, and loan those shares to you. So you're actually borrowing shares of a stock that you will have to return at some point, pay them back later. The investor then sells the borrowed shares on the open market. Before the borrowed shares must be returned, the investor is betting that the share price will decline so that she can buy them back at a lower price than sold. Okay, borrow the shares, sell them on the open market, and then if the investor is correct about direction and the price of the stock does fall, then the investor can go back into the open market, buy those shares back at a cheaper price than where they were sold, and the broker takes over from there and returns the shares to the proper place where they came from. To close a short position, trader buys back the shares on the open market and returns them to the lender. Trader is responsible, though, for any commissions, fees, or interest charged by the broker. FINRA and the Federal Reserve have set minimum values that the trader's margin account must maintain, known as maintenance margin. So not anyone can just short shares. You need to have a margin account, and you need to have enough money in that account to support the required maintenance margin. If trader's account falls below the maintenance margin, more funds are required to be deposited immediately, or the broker may sell traders' positions. Now, the broker may not close. It's up to the broker how they want to satisfy that maintenance margin. They can do whatever they want. When you signed all those papers, when you opened your account, you agreed to allow the broker to, at their discrimination, choose what to sell, and they will do it, and they'll do it quickly, and they don't need to send you a request for permission. You've already given them permission to satisfy maintenance margin when you open that margin account. The risk of loss on a short sale is theoretically unlimited, since the price of an asset or the price of that stock can climb to infinity. Short selling has high risk, high reward ratio. It can offer big profits, but losses can mount quickly and infinitely due to margin calls. So, for those reasons, you can see how short sellers could get into trouble if the stock does not decline in value as they expected. A short seller is under a lot of pressure to keep that maintenance margin up to date and at the proper level. And if the price of the shorted stock goes up, this is going to represent losses in that trader's account. Let's take a look at an example of short selling for a profit. Imagine a trader who believes that XYZ stock, currently trading at $50, will decline in price in the next 3 months. So they borrow 100 shares and sell them to another investor on the open market. The trader is now short 100 shares, since they sold something that they did not really even own, but instead had borrowed. The short sale was only made possible by borrowing the shares, which may not always be available if the stock is already heavily shorted by other traders. So sometimes in your brokerage platform, you will see the term easy to borrow. I think that's the term that you'll see oftentimes on a stock page. Easy to borrow or not easy to borrow. It slips my mind exactly how they phrase that right now. But sometimes certain stocks are not easy to actually short. Either there's not enough people holding that stock long at your particular broker's, in your particular brokerage platform or your broker's overall accounts, or there's already too many people shorting that stock and there's not enough shares to borrow from anybody else to provide you shares to short. So it's not always possible to short any and every stock. A week later, the company whose shares were shorted reports dismal financial results for the quarter, and the stock falls to $40. The trader decides to close the short position and buys 100 shares for $40 on the open market to replace the borrowed shares, which he had previously sold for $50. The trader's profit on the short sale, excluding commissions and interest on the margin account, is $1,000. The $50, of course, minus $40 times 100 shares is $1,000 of profit. Example of short selling for a loss. On the other hand, using the scenario that we just went through, let's now suppose the trader did not close out the short position at $40, but decided to leave it open for a while to capitalize on even further price declines. However, a competitor swoops in to acquire the company with a takeover offer of $65 per share, and the stock soars. If the trader decides to close the short position at $65, the loss on the short sale would be $1,500. The $50 collected minus the $65 now payable to buy those shares back equals a negative $15 per share times 100 shares is $1,500 loss. Again, plus commissions and interest and any other fees charged by the brokerage house. So you can see again here how a short seller can get into deep doo-doo in a hurry if the stock goes the wrong way. Here the trader had to buy back the shares at a significantly higher price to cover their position. The short squeeze. If a stock is actively shorted with a high short float and days to cover ratio, these are short stock terminologies. A high short float is the percentage of the available shares that are out there on the market. And if there's a large percentage of those shares that are out there that are already shorted, this would be what would be determined as a high short float and days to cover ratio. Is also at risk of experiencing short squeeze. A short squeeze happens when a stock begins to rise and short sellers cover their trades by buying their short positions back. This buying can turn into a feedback loop. In other words, demand for the shares attracts more buyers, which pushes the stock even higher, causing even more short sellers to buy back or cover their positions. A short squeeze is an unusual condition that triggers rapidly rising prices in a stock or other tradable security. For a short squeeze to occur, the security must have an unusual degree of short sellers holding positions in it. The short squeeze begins when the price jumps higher unexpectedly. The condition plays out as a significant measure of the short sellers coincidentally decide to cut losses and exit their positions. So it's a feeding frenzy, if you will. Short interest is often used as an indicator. The possibility of a short squeeze is one reason some analysts look at a high amount of short interest as a bullish indicator. Short interest is the fuel. Performance is the fuse. Now, let's get into talking how to benefit from a short squeeze. Are there any questions? Thanks, John. Answers hard to borrow is the terminology I was looking for. John got that in there for me. Thanks, John. Strategies to benefit from a short squeeze. All right, well, let's talk about some ideas. any long or bullish, in other words, position stands to possibly benefit from a short squeeze. You could go get long the stock, just buy the stock. Problem with that is unlimited downside risk to zero. Or you could consider buying long call options, whether they be in the money, at the money, out of the money, doesn't matter. They all have limited risk. However, they are subject to implied volatility crush. Of course, what we're talking about here is doing a through the earnings strategy where we put this trade on prior to the earnings event with the expectation, or at least the hope of, excellent earnings that triggers a short squeeze. And in that case, you're buying ahead of the earnings, holding through the earnings event, and therefore long call options are subject to implied volatility crush, which we talk about in these webinars all so often. Long straddle or strangle. Well, these are subject to double IV crush because now you've protected your downside risk of the long stock, your limited risk of a long call. Now you can win in either direction, whether it be up or down. But the problem is if the stock doesn't move at all, you're subject to double the implied volatility crush because now you own a call and a put, or several, multiple of each, whatever the case might be. How about a long vertical call spread? We've been talking about hedging our bets and doing spread trades. And in some very recent webinars, we spent a lot of time and effort and energy talking about hedging simply by doing option spread strategies. Long vertical call spread, also known as a bull call spread. Great strategy. However, it caps the upside. It limits how much upside potential there is for a trade. And in a short squeeze, we want unlimited upside. We want to see a furious situation where traders are being forced to continue to buy at higher and higher prices and let that thing run. So a vertical call spread caps the upside. How about some credit trades, short puts or short vertical put spread, also known as a bull put spread. Low maximum profits again. Calendars and diagonals, limited maximum profits, possible overshoots. In other words, the price skyrockets, but even goes past where your profit potential, profit window is, depending on how you design the strategy. Butterflies, condors, narrow profit windows. Again, the case of overshoot. We're looking for a big move in a short squeeze and to the upside. Wouldn't it be nice to have a strategy that we could have unlimited gains to the upside, but even win if we're wrong about direction? That would be the back ratio. A short squeeze option strategy to consider is the back ratio. We've had webinars in the past where I spent a lot of time discussing a front ratio, or also known as a reverse back ratio. Today, we're going to talk about the back ratio, which has unlimited upside profit potential. Unlimited upside profit potential. Defined risk, and can be designed to have profit even if you're wrong about the direction. So you're betting for on a short squeeze, and the company comes out and they have terrible earnings and the stock falls, it plummets. It's okay. Designed properly, a back ratio can even provide a break even or a small profit to the downside when you were wrong about direction. The downside to the back ratio is similar to a long call, because honestly, built into a back ratio is a naked long call. And the downsides risks are primarily, from my point of view, negative theta, which can be mitigated because we aren't really looking to hold this trade very long. Hopefully, this is a quick trade where profits can be taken immediately within one day. Long vega, however, does submit the trader of the back ratio to some IV crush. The callback spread in risk profile looks like this. Also known as a ratio spread, it is a strategy that involves selling a lower strike price call, represented by point A on this graph. Okay. And then buying a larger number of higher strike price calls, represented by B. This is the zero line on a risk profile. Anything above the zero line is profit. Anything below the zero line is loss. The lower strike price is usually an at-the-money option at the time of execution. So when you put the trade on, generally speaking, this one that you sell is going to be the at-the-money strike, or very, very close to the at-the-money strike. And then this one is going to be an out-of-the-money, but you're buying more contracts. Okay. For example, sell one, buy two. Sell two, buy three. Sell three, buy five. Whatever ratio suits your risk reward profile. Designed properly, you can see if the stock falls, this trader actually can still make a small profit. If the stock does what we're hoping it's going to do, that is enter into a short squeeze situation, the profits are unlimited to the upside. Let's look at an example. If the trader executed a back spread by selling a 50 strike price call for $3, okay, sell the 50 strike, the first point A, for $3, and then buying two 55 strike price calls for $1.50, right? Sell one for $3, buy two at $1.50, the trader would be able to put this trade on for a zero out-of-pocket cost, right? That would be no debit, no credit. It would be you buy one for $3, sell two at $1.50, so you end up with zero out-of-pocket costs. If the stock stays below $50 at expiration, the trader will break even because all options will expire worthless. The $50 short and the $2.55 longs all expire worthless. You didn't put any money in to get into the trade, and all the contracts expire, and we're hunky-dory. End of trade. But if the stock trades to $55, this is the worst case scenario. The worst case scenario is if price trades to your long strike, because the lower strike price call, the 50, would now be $5 in the money. The short that you sold is going to be $5 in the money, while the 55 strikes, what are the money? They expire worthless. Here the investor loses a full $5 to buy the short back for $5, and there's no value in his longs. Another scenario, if the stock trades to $70, then the trader will lose even more on the short, right? The short 50, now the stock's at 70, the trader's going to lose $20 on the 50 strike price call. But he owns two of the 55 strikes, and those are going to be at 70, $15 in the money. So both the 55 strike price calls will be profitable for a total profit of $10. The $30 profit on the 55 strike calls minus the $20 loss on the 50 short call. Any questions? Anyone have any questions? This week's short squeeze trade ideas. Okay, let's do this. Chewy, GameStop, king of the short squeeze trades. When was that whole scenario? That's over a year ago. Boy, time flies. GameStop, AMC. I don't remember who else there was. But this week, there are some stocks reporting that have relatively high short interest. Let's go over to optionslam.com, my favorite website of all time, and take a look at what's going on. If we go to the earnings tab and go to the stock screener and just use my generic screener, saved screeners, these are saved screeners. My generic is very simple. It's just looking for EVRs over 1, stocks that trade over $20, and 2 million in average daily volume as kind of a liquidity screener, and looking for stocks that are reporting earnings within 1 week of today. There you see Chewy, GameStop. What was the other one? CPRI. Okay. CPRI is Capri Holdings. Okay, I can't usually remember the name of that stock. Capri Holdings. So let's take a look. Here, this column right here is short interest. Now I could, for example, screen by short interest up here and look for only stocks that are going to have a short interest. Here's my short interest level. Okay. We could screen by stocks that have a short interest level of at least 10, for example. A minimum of 10, no maximum over here. We'll leave that blank. Okay, so I'm just changing my generic screener on the fly here, and we'll rerun that screener, and you see it comes up with those 3 stocks that I've already identified. These are the 3 stocks that have short interest currently above 10. And wow, some of them are seriously above 10, with Chewy being at 28.54. This is a serious high short interest level. Okay? Any questions? All right, so we've got 3 stocks to look at. Let's start with take them in this order. CPRI. We'll start with CPRI first, then we'll go to GameStop, and then finally we'll wrap it up with Chewy. All right, let's go over to Thinkorswim, CPRI, and take a look at designing a back ratio. Now, the first question one might ask, I already told you that the short is going to be a generally when doing back ratios, we use the at the money strike. Okay, the at the money. Why? Because it gives us the most extrinsic premium in the other strike. At the money strikes hold the most extrinsic premium. Then I'll talk a little bit about how to choose your long strikes here, and that's pretty simple. But first, before we get into that, how far out in time? So gravitate to the regular monthly options, but it depends on how many days there are. Regular monthly options have better liquidity than weekly options. We could choose the options that expire this Friday, but to give the trade some time, decrease the amount of negative theta that we're exposed to, we might want to consider buying more time by going further out. And I'm going to go to either the June or even the July options. Now, this is a relatively low price stock, so it would not be unreasonable to take a look at the July options in time, out in time, 45 days out. And the at the money strike is going to be the 25. That's going to be the closest strike we have to being at the money with the stock at $26. So to create our first back spread, we simply sell one of these, okay, and staying in the same exact expiration, we look to buy something that is about half the cost or less. Because if I sell one of these for $4 and let's say 45 cents, okay, the midpoint price would be $4.45. I've got $4.45 to work with. I could buy something up to $2.20 easily. Well, the 30 is not quite there. It's going to take me a little bit over. Two of those is going to be more than $4.45, right? So to do this trade for a credit, I would need to buy the 35s. And I could actually buy two of those, sell one, buy two. I got $1.93 credit. I could actually buy three of these and still have a credit. Okay? So I've got sell the 25, buy three of the 35s. Let's take a look at that in risk profile. Very familiar to what we were just looking at in the PowerPoint presentation. Here's a risk graph that is going to be if with the stock trading right here, $26, if a short squeeze ensues and price is able to power up, here's the one-day trade P&L line. And the blue, of course, is the expiration graph. So the break even here, because don't forget, the worst case scenario is at the strike that I bought, with price to end up and hold this trade all the way to, if the trader were to hold this all the way to July, which is not the recommended way to trade these, right? We're looking to, as we saw in that example, the trader who remember shorted at $50 and then the stock fell to $40, but the trader held on, and then something happened in the market. A buyout came along and the stock soared. So, it's important to, take profits along the way. But bottom line is unlimited potential for profit. And even if you're wrong about direction, if the stock does go south, you keep the $72 credit collected for this 1/3 ratio back spread. Let's look at another example with the same stock. Let's look at, now we can do, I should have left that one on there. Let me put that one back on there. So I'm going to short this and buy 1, 2, 3 of those. Okay, there's that trade. All right, and we'll and the problem with this trade that I don't like about it is that it's a long way to the break-even point. It's a long way from 26 all the way up to 39 to the expert. Even though I don't intend on holding the trade all the way that long, it's a long way. Okay, so a move to 35, if it can happen immediately tomorrow, would bring in possibly $450 of profit, minus, don't forget, there is 1 day of theta decay and there is also IV crush. Okay, so there would be a discount to that calculated profit of $450. There would be a discount to that profit, undetermined amount, depending on how bad the IV crush is. The maximum loss here is about $900. So that would be for the stock to trade up to, right, the worst case scenario. The short is going to be in the money as the stock goes up, but the longs don't return any money until the price exceeds the strike, the long strike. All right, so scenario one. Let's look at another idea, and let's do this. Again, we will sell the at the money, but instead of going out and buying 3 of the 35s, let's just buy 2 of the 30s. All right, I'll uncheck that top trade, and we'll take a look at this trade. Now, this trade, if you look closely here, you'll see that the blue line is below the 0 line. So you're not going to make a profit because why? You were not able to collect a credit for the trade. This is a debit trade, buying 1 of the 25s and selling 2 of the 30s. But it dramatically improved the probabilities of profit if we are right about direction, in that the stock only needs to go to like 35 now to break even, whereas the other trade, 35, was the max loss. Okay? John's got a great idea. Change the ratio of the 25-30 ratio of 1/2, and we'll sell 2 of these 25s and buy 3 of the 30s. It gets our break even back up into that 39 zone, okay? But it solves the problem of if we're wrong about direction, we end up with a healthy $1.69 credit on this trade. Great idea, John. Thanks for sharing that idea. All right, let's go on to the next one. Now, GameStop. And by the way, I'm going to suggest that if anyone's interested in actually trading this kind of a strategy, it's a gamble, it's a crapshoot. We don't know what the market's going to do when we hold a option strategy through the earnings event. It's a coin toss. A coin toss. Did I say coin toss? It's a coin toss. And also don't forget to take into consideration overall market conditions, right? What's the market doing? We're in kind of some might even say that we are in a bear market right now and experiencing a bear market correction or a strong pullback inside of a bear market. Others might disagree with the bear market concept altogether. To each his own. But bear markets bring in a lot of short sellers. Okay? Bear markets attract short sellers. So the possibility of a short squeeze, it could be argued, increases in bear markets. If you get a bull rally inside of a bear market, which coincides with your earnings stock having a better than expected earnings event, this is everything coming together for the short squeeze trader utilizing the back ratio. GameStop is currently nowadays a much more expensive stock, and the options will gravitate immediately to the Junes because I already know the options are pretty pricey in GameStop. The IV is pretty high in GameStop. You can see IV numbers approaching 300%. Okay, yes, I said that right, 300%, with the Junes at 180%. So you know the options are going to be expensive. Scroll down to the at the monies. Sell the at the money 120 strike, slightly in the money. It's at 122.70. You could choose to sell the 125, but that's going to bring in less credit. And it's a toss up which one you choose, but I'm going to gravitate to the slightly in the money as opposed to an out of the money strike for my short contract, just because I can bring in that much more money. That means I don't have to go that much further out in order to buy my other two contracts. So selling that for approximately $17, two contracts that are somewhere around $850. So here's 855 at the 145s. Let's try that. What if I buy two of those? I got a 3-cent debit. Well, it doesn't get much closer to break even than that. That's about a break even trade. If you put this trade on that had the potential for unlimited profit, and it only costs you $3 to go in, $3 to get into this trade, doesn't sound like too bad of a deal. However, let me caution you that the risk is substantial, because the risk is a couple grand, about $2,500. When you sell that 120 for essentially, we'll call it break even. Right now, the price just went to break even for a second, so I'm gonna just lock it in there so that we can talk about that. If you're able to initiate this trade at break even, you're the 120. If price goes to your long strike at 145 and you hold the trade all the way to expiration day, this is the worst case scenario of about $2,500 loss. As you can see in this left-hand box where I put my cursor, it tells you what the profit loss would be. And in purple, today, if the price went there today, we would have $550 of profit. You see that in purple over there in that little box on the left. Or if price is there on expiration day, there's a $2,500 loss there. So there's GameStop. Even though you put the trade on for net zero out of pocket cost today, there is a risk of up to $2,500. It is defined. You can't lose more than that. That's the most you can lose. All right. And then let's see. Who else was on our let's see, we'll go back to Option Slam, and we had CPRI, GameStop, and Chewy with the highest short interest of them all. And the good news about that is it is also the lowest price stock on the list. I'm going to just I'm going to clean up this filter here. I'm going to change this to a $5 minimum price and see if there are any other high short interest stocks that are even cheaper than Chewy. So I just changed that stock price of 5 or greater. And I do get one more. CHPT. ChargePoint Holdings. High short interest on the ChargePoint. I discovered another one here that's even cheaper than Chewy at $13.45. Not as high of a short interest, but higher than CPRI. Okay, at 16.45. So there's another one to investigate and analyze. And what I would suggest, if you were to put the trade on is to do it small and do it against 3 different stocks. For example, set a maximum tolerated risk of X amount of dollars. Let's say you're willing to risk $1,000. Design 3 trades on 3 stocks where your risk is no more than $1,000, or right at or near the targeted amount of $1,000, and put the trade on 3 different stocks. This is going to increase your odds of hitting a home run. Because that's what this is all about, folks. This is a home run type of an attempt here. So let's go to Chewy and let's take a look. CHWY. Looks like I already have a couple modeled up here. Let's see. Yeah, we're running almost out of time here too. Okay, OPH. I did Chewy first, really? Okay. So we need to do CPRI. Let's see. CPRI. Is that the one we didn't do? Yeah, I know. Thank you. Thanks, Doug. I know that. But CPRI, the one we didn't do, and CHPT. CHPT and CPRI are the 2 that we. Is that correct? Okay. Thank you. All right. All right. CPRI. All right. We'll scroll down. CPRI. We'll scroll down to the at the monies. Again, we're going to at the money is 49. So we sell the 49, and then we look for something that's going to be half the price, something that's going to be about $1.80 or so. Well, I see the $1.20 here, so I'm going to go and control buy the 2 of those. Brings in $1.10 credit, so that's a pretty healthy credit. And there's a risk profile. I'll set the shading to be June, so you can see where 1 standard deviation is. So you can see it takes a substantial move out to 1 standard deviation to get that profit. Okay? So it does take a substantial move. And what's nice about this trade is even if we're wrong about direction, we get to keep the $110. And then last but not least, CHPT for our now with CHPT, a low price stock, we could maybe go further out in time, out to the Julys. Let's see, it's a $13 stock. It's got options priced at the $1 increments. Fairly tight bid-ask spreads. It's all looking good for charge point back ratio. Let's sell the at the money 13 strike. Look for something that costs about 60, 70 cents. Okay, I don't see 70, but there's the 60 cents at let's see, if I did the 16, what if I did the 16 and I bought 2 of those? Yeah, I can do the 16 and get a very small credit. Beautiful. Beautiful. Look at the risk profile. Adjust our I need to adjust that out to July, don't I? July, I would adjust this out to July to see where the 1 standard deviation is between now and July. However, I don't intend to hold this trade out to very long at all. I'm either going to be a winner or a loser, certainly by the end of this week, hopefully tomorrow. Hopefully tomorrow. Okay, and then OPH asked the question, says, why not just buy the 170 call instead of doing the back ratio? Well, again, like I said in the PowerPoint, with buying just a call gives you no downside protection. So if you're wrong about direction, doesn't matter if it's an at the money call, in the money call, or an out of the money call. You are totally directional. The advantage to the back ratio is that you can win even if you're wrong. That is the main advantage there, OPH. All right. Okay, let's roll time to the next hour for this presentation. Okay, I'm not sure what that means. We are an hour later today. Doing these webinars are usually at noon Eastern time. Today I had a doctor's appointment that I could not reschedule, so that's why today's late. Next webinar will be back to the original noon time. That may please or displease some of you. Okay, well, listen, folks. Wayne likes the 1 p.m. Eastern time. The reason I don't do it at 1 p.m. is I like the noon better because I'm actively trading in the afternoon, and I prefer to concentrate on my trading in the afternoons. And the noon hour is kind of a slow time of day. Oftentimes the markets kind of take a rest, busy in the morning, take a rest around the lunch hour, and then get busy in the afternoon towards the close hours. So, okay, well, everybody, thanks for being here. Thanks for your great comments and questions. Don't forget to email me, optionslam.com@gmail.com with your suggestions, comments, and questions. Goodbye for now, and good trading.